You buy a pair of shoes for $100. Then, you pay with a credit card and leave the store. At the end of the month, you pay the full bill. You paid zero interest, but the system still made money. So, where did that money come from? To answer that, we need to follow your $100. A card payment connects several different businesses. Each one performs a different job and charges for it. First, there is you, the cardholder. Then there is the merchant selling you the shoes. Your card was issued by a bank called the issuer. The merchant also uses an acquiring bank or payment processor. Between them sits the card network, such as Visa or MasterCard. It carries the payment message between the different banks. When you tap your card, the terminal sends an authorization request. It asks whether this $100 purchase should be approved. The request travels from the merchant to its processor. Then it crosses the card network and reaches your issuing bank. The issuing bank checks your account, available credit, and fraud signals. It decides whether to approve or decline the transaction. The answer travels back through the same chain. A moment later, the screen shows the word approved. But approval does not mean the money moved instantly. It only means the bank has promised that the payment can proceed. Later, the merchant sends a batch of completed transactions. This stage is called clearing, and it confirms the final amounts. During settlement, money moves between the banks. The merchant receives the sale amount minus several payment fees. Imagine the shoes cost $100. The merchant might receive $97.50. The remaining $2.50 is only an illustrative example. Real fees vary by country, card type, merchant, and agreement. The total amount withheld is often called the merchant discount. It is not one single fee paid to one company. Part may go to the issuing bank as interchange. Another part goes to the network and to the processor. The merchant accepts this cost because cards make payment fast and convenient. They can also increase sales and reduce the handling of cash. Now we can answer the original question. Even when you pay in full, the issuer may earn interchange revenue. The network can earn assessment and processing fees. The merchant's processor also earns money for handling the transaction. These amounts are not fixed everywhere. Regulation, competition, card rewards, and merchant size can change them. Interest becomes important when a cardholder carries a balance. Instead of paying everything, the customer leaves part of the bill unpaid. The unpaid balance can then generate interest. Paying only the minimum can keep that balance alive for much longer. Card issuers may also charge annual, late, cash advance, or foreign transaction fees. Which fees apply depends on the card and the country. Visa or MasterCard usually do not lend you the money directly. The issuing bank provides the credit and receives the interest. The card network mainly connects institutions and processes payment information. The acquirer or processor serves the merchant side of the transaction. So what about points, miles, and cashback? Those rewards are part of the card's overall business model. They can be funded by transaction revenue and other card income. They are valuable, but they are not created from nothing. Some customers generate mostly transaction revenue. Others also generate interest and additional fees. A credit card is therefore more than a short-term loan. It is a payment system connecting a customer, merchant, banks, and a network. You can pay no interest and still create revenue when you use the card. That is how the system can profit even when you pay in full. In the next video, we will explain what happens when you pay only the minimum and why a small monthly payment can make a balance surprisingly expensive.